Don't shy away from smaller lenders or smaller mortgage companies. And why is that? Well, there's lots of reasons to do so. First of all, the money is the same no matter where you go. So where you've got to pay it off, it's your money. So basically, it's the same wherever you borrow it. So it's all about what you pay back that really matters, okay? So the benefits of using a smaller mortgage company, there's lots of reasons. One is they're more focused, client focused. The good part about that is you'll probably understand that all the big four banks, they have a very, very large portfolio of clients, obviously. So their time to be able to sit down and be client focused on you as a client doesn't really happen. So you get a very much personalized, customized service. And they're very good for looking after clients that so that their products are more niched for different sorts of things as well. So you'll find that the smaller companies may offer better rates. So whether you're a first-time homeowner, whether you're a seasoned investor, a self-employed client or whatever, sometimes you go down to the bank, you're not going to fit into any of their products because they might only specify, and they're very tight and rigid on what they're allowed to borrow, who they're allowed to borrow, to their credit policies. So you might not even fit into their criteria. That's why it's good to use a mortgage broker, because although we do have the big four banks, and if they do offer a great product, yes, we will look there, but we will not shy away from smaller lenders as well, or smaller mortgage companies. So let me explain a little bit about who they may be. So by the way, if you don't have the book, great idea to sign up for it. And you'll find that on page 26 and 27 of the book, it really does explain about banks, second-tier banks, building societies, credit unions, non-bank lenders, what their role are in the marketplace. So it's a good idea to have a true understanding on who they are and an education around the different types of lenders who support local communities and what they actually offer to you as a client. So, so there's lots of different points in here to take into account. Your banks, as you probably already know them, your big four, your ANZ, Westpac, Commonwealth Bank, Suncorp, or so forth. Then you've got second tiers. You might know a few of these: Macquarie, ING, St George, Bank of Queensland, local banks, Bendigo Bank, and so forth. So they're more community focused and local community banking. You got building societies and credit unions. They are the same as well. These are non-profit cooperatives, are owned by people who use their services. Their rates can be very competitive as well. Then you have non-bank lenders. They don't hold an Australian banking licence, so they cannot accept deposits. They therefore source wholesale funding by investors, financiers, trusts, and even the big four banks as well. But they're really good for property developers, investors, and so forth. And they do more complex lending as well, which are the non-bank lenders. But they're nothing to steer away from. But using a mortgage broker, we have a true understanding on what the banks offer, what their credit policies are, and what suits you as a client. So I wouldn't shy away from them, most definitely. So if your mortgage broker says, hey, have you thought about ING? Or I found Pepper, or I found Macquarie, or they name a bank, I don't even know who they are. So it's not about who you know as the bank or the company name. It's money. The money that you're going to borrow back to the bank that is the most important to you. What product they offer you, what service they offer you. Do they look after you as a client? And are they offering you the best rate? Like as an example in the book here, it says here, a case study, don't pay more than a brand name. There was a study done. They had at lenders A, B, and C. It's in the book, mind you, too. If you want to have a read of it, just download the book. It's free. So lender A was 5%, lender B 5.10%, lender C 5.25%, and lender D 5.3%. Now, lender D offered a discount package, and the thing is with lender D was one of the big fours. The others were all smaller mortgage companies. So, it's a good idea, to put simply, a typical borrower could usually, so if you think about that, so that lender D was costing $400 a year, extra. $1,200 a year, that's an insurance payment, a yearly insurance payment on your house. So, I wouldn't shy away, most definitely. So considering a smaller mortgage company compared to a big four. So if your mortgage broker is going to offer you a smaller mortgage company name, you're not sure about it, just ask them. Ask them more information about who they are. What do they do? Who do they niche for? And why did you choose them? Because we got to do that anyway. We have to give you options. We're not going to put you straight with a smaller lender as it is. But if we feel that it's in your best interest and a better loan for you, of course we are. Of course we're going to do that. All right. Now, see you later. I hope you found the information useful. If so, make sure that you subscribe to the channel. And I just want to let you know that we have a free giveaway, a free book, and subscribe to it now. So the link is below. It's the 7 steps to mortgage freedom and wealth through property. Inside here, you will find out how to get the cheapest home loan, why you should really care about your home loan, why people will end up broke, and also we have some bonus chapters at the back here as well. It's a great read. It's an easy read as well. So make sure you get your copy and share it with friends. See ya.